Hello and welcome to this third tutorial in our series of introductory video tutorials about Forex. In this tutorial, we aim to understand the entire process about trade execution, right from the point that a trader places an order on his trading platform to how it is routed to get the best fill in order to complete his order. Through this video, we will also be discussing about the role of the Forex brokers in this process of trade execution and the different types of brokers and the trade execution models used by them, which can be classified into the following two types, that is the non-dealing desk execution model or the dealing desk model, also known as the market makers. To begin with, let's examine the role of a Forex broker in helping us trade in the Forex markets. A Forex broker is an intermediary or a middleman between the retail traders, like you and I, and the interbank markets. They have the technology to provide us with a platform to access the currency markets alongside major market participants such as the banks, corporations, hedge funds, etc., also known as the big players. For each buyer of a currency, they connect the trader to a seller through the electronic communication networks. This way, they help traders get access to price feed or the market quotes received from the banks onto the trader's trading platform. Forex brokers are classified into two types based on their trade execution model. These are the dealing desk brokers, also known as the market makers. And secondly, we have the non-dealing desk brokers. We shall now understand the trade execution model followed by each one of them in detail. Starting with the dealing desk brokers, also known as the market makers. Dealing desk brokers quote a price to the trader for the order that he places and hence makes the price for the trade to buy or sell the currency at. So if the trader buys a currency, the dealer at the dealing desk quotes him a price based on the price feed which he gets from his liquidity providers. It is then this price that the dealer quotes to the trader who wishes to buy the currency. That price feed or that price quote becomes the selling price for the dealer and the buying price for the trader. In this way, the price which the trader sees on his trading platform is the price that the dealer is quoting him to sell the currency that the trader is interested in buying. This way, a dealing desk broker acts as a counterparty to the trader. So the broker profits when the trader loses and vice versa. Then we have the NDD or the non-dealing desk brokers. NDD broker provides traders direct access to the interbank market without any dealer intervention. They are not market makers and do not act as counterparty to the clients. Clients' trades that they place on their trading platform are filled as market orders at the best available market price. In doing so, they provide lower spreads and swifter trade execution to their traders. An NDD broker routes the orders through an automated STP system, that is the straight-through processing system, into the ECN or the electronic communication networks for them to be filled at the best available market prices. So what exactly is the STP? STP stands for straight-through processing. It is an automated process of routing orders directly from the client's terminal to the interbank market or the trading networks. By doing so, it provides the traders access to the real-time market quotes and offers them swift trade execution without any dealer intervention. Now that we have discussed what the STP system is, we shall try to understand what ECN is and how it works. ECN stands for Electronic Communication Networks. ECN uses STP process to route orders into the trading networks. These are communication networks available for all market participants to trade against each other and allow the client's order to interact with other clients' order in addition to the interbank markets itself. These ECN setup allows the client's order to interact with other clients' orders as well, in addition to the interbank market price feed that is available. We shall now try and understand how the trades are routed by these brokers once the order has been placed by a trader on his trading platform. Starting with the dealing desk brokers. As discussed before, dealing desk brokers quote a price to the trader for the order he wishes to place, and hence make the price for the trader to buy or sell the currency at. Once the order is placed by the trader, it is received by the broker at the dealing desk, who quotes a price to the trader which he sees on his platform. So if the trader buys a currency pair, the dealing desk broker will quote him an offer price which the trader sees on his trading platform as the ask price. This way, the broker acts as a counterparty, in this case a seller, to the trader. So the broker profits when the trader loses and vice versa. Some dealing desk brokers also simultaneously hedge their trade positions by taking the same trade position as that of the trader with their liquidity providers. So if the client bought a currency pair, the dealer would be the seller to the client, but himself a buyer of that same currency pair with the banks or his liquidity providers. So as we see in this flowchart here, the trader places an order to open a trade on his MT4 platform. The order is routed to the broker's dealing desk, received by the broker. The broker then quotes the trader a price for his order, and once the order has been accepted, he takes the opposite position to that of the trader. This completes the process of opening a trade once the client places a trade position on his MT4 or the trading platform. The step here is what some of the dealing desk brokers do. They may take the same trade position as that of the trader with the banks at the best available price which they get from the banks. Now, when that particular order is being closed, the trader will again place an order to close that open trade on his platform. This order is again routed to the dealing desk of the broker. The broker again quotes the trader a price to close his order, and once that order is accepted, he closes the opposite position to that of the trader. So for example, if the trader, while opening the trade, had bought a currency pair, the dealing desk was a seller to him. Now, at the time of closing the trade, the trader would be selling the same currency pair, while the dealer at the dealing desk would now be the buyer of that same currency pair. Again, if in case the dealer at the dealing desk had taken the same trade position as that of the trader with his liquidity providers, he will also then, at the time of closing the trade, also close his position with that of his liquidity providers. Next, we discuss how an NDT broker routes the trades placed by their clients on their trading platforms. An NDT broker transmits the orders placed by the client to his liquidity providers, that is the banks which provide the price feed to the broker, via an automated STP system. The banks, who are the market makers, provide the broker with the best available bid and ask price. The broker would then typically add a markup in this spread as his profit for providing this service, and those marked up spreads are what are shown on the trading platform to the traders. So when a trader places a trade on his platform, it is STP'd to the interbank market and is filled as a market order at the best available bid or ask price depending on the type of order. So the NDT broker, unlike the market makers, do not create their own prices. They instead provide direct access to the interbank market and therefore provide lower spreads and swifter trade execution. Therefore, mostly NDT brokers would provide variable spreads on their trading platforms, as those spreads are the real spreads as available in the market. In some cases, the brokers may even charge a commission as a compensation for providing better spreads to the traders on their trading platforms. So what does the Forex broker earn by providing this service to to the traders. A dealing desk broker acts as a counterparty to his clients. Therefore, the broker profits when his clients loses money. In addition to this, they may also charge the spreads and the commissions, which add as additional profits. And the non-dealing desk broker, they are compensated either by the spreads or the commissions. An entity broker may add a markup to the spread received from the banks, and this markup is their profits. The broker may charge a commission per trade instead of the markup, or they may even do a combination of both spread marked up and commissions. So this is all that we will be covering in this video tutorial about trade execution models used by different Forex brokers. Thank you for taking the time to watch this video.